Hello and welcome to another episode of the Opus Well Style Podcast. My name is Ivan Watanabe here with a good friend of mine, Sinohe Terrero. How are you, brother? What's going on?
I'm doing pretty good, man. Pretty good. Out here in the West Coast, we got a little better weather than you guys.
Yeah,
I'm
most
good.
definitely. It's sunny outside, which is a blessing, but it's 20 degrees today. So I am, it is like bone chilling cold, man. It's brutal. It's brutal. But I appreciate you joining us early this morning. Really excited to have you on. It's been a while for us to have you on, and so we're psyched to have you. But before we start, as the CFO and COO at Envoy, would love to find out more about you, have the audience learn more about you and what you're up to and your background, and then we can kind of, start our conversation.
Yeah, sure. So I'm Sinohe Terrero for those that are listening or watching, and I'm the CFO and COO of a company called Envoy. It's a tech company in San Francisco. We're a workplace management company. So if you've ever signed in on an iPad going into an office, you probably used our product. I've been there for 5 years, and I run more or less the things that you think. Let me start that again. I've been there for 5 years, and I run more or less the things that you would expect from a CFO. So like data, FP&A, accounting, but some other operating things like legal, risk, deal desk, HR, recruiting, and currently I'm the interim CMO. So I wear a lot of hats. But been doing the tech thing for a very long time. Before that, I was at a tech startup called Quid. Before that, at another tech startup in San Francisco called Indiegogo. And then before that, I was at Etsy, where I was very early days at Etsy back in Brooklyn, New York, where I'm from.
Love it. And that's sort of a great segue, right? You have a great background in startups. And now with a larger organization, so you've sort of seen the gamut in the tech space. We have a lot of clients, and a lot of our audience are either at a startup, exploring a startup, and fundraising is a constant conversation, right? And for a long while, and I'm not telling you anything new that you don't know, but for the listening audience, fundraising was like the wild, wild west. I mean, there was just money getting thrown around left and right all day, regardless of the company. You could never, ever, 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 ever have had any positive cash flow, and you'd still get funding. It was wild, right? So, what I thought we would start with is just sort of like, what do you see in the landscape of borrowing money and funding different startups today? Like, how is it different from your experience at those previous ones, and what do you see the kind of market look like right now?
Yeah, I advise a lot of companies, particularly earlier stage companies and founders in this same, trying to navigate the fundraising landscape. And what I keep saying is, the next 10 years are nothing like the last 15. And we all have to get, really used to a new normal, right? We've come off an incredible period with 0% interest rates, PPP loans, extended unemployment, and all of the other things that really, artificially fueled an economy. And, private equity was borrowing at 0%. So there was just a lot of money to be thrown around, and people were willing to take pretty big risks, again, because the money was free. Yep. We're in a completely different environment now, and I think a lot of companies are struggling from a few things. One is the valuations that were had between like 2020, 21 to 23, right? We're not seeing those valuations right now, and so a lot of companies raise a ton of money at incredible valuations, and they're never going to raise money again at those valuations, and it's going to be some hard decisions to be had. On the lower end, the Series A, Series B, seed, the bar is much higher into what is expected for you to actually get funding or lending at this point. So it's a different environment. It's tough, and people need to really rethink the way that they're going about the market and the way that they thought about fundraising.
Yeah. And what's your take on it? Do you feel like now is sort of a healthier evaluation of companies, or do you think it's overly strict? What's your take when you're seeing it? Does it make sense? Is it like that's actually like, yeah, that's where you should be as a company?
That's a great question. I think that the answer is yes, but, right? So I think looking at it financially, when you look at the financial metrics of some of these companies, some of it just was completely unreasonable. The valuation multiples. I know a company that raised at a $2 billion valuation, and they had like $16 million in ARR. I mean, it was just quite frankly bananas. And so there is a resetting that was necessary in the space for sure. On the flip side of that, if we don't get the funding for these innovative companies at those kind of multiples and valuations, we would never have some of the innovations we have now, right? Like we wouldn't have Uber, right? Like when you think about Uber, for example, the VCs were subsidizing our rides until they figured out their business, right? For years. Instacart, same thing. The VCs were subsidizing our food delivery until they figured out the business. And so a lot of multiples didn't make sense, but that's what actually facilitated the innovation. And we need a little bit of that. But I think that 2022, it just went a little bit too awry, and we needed to reset it a bit.
Just because the money was it was free, right? It was free money. You know, when you're advising these startups, when do you think it's the appropriate time to start raising funds? You know, are there certain benchmarks that you recommend companies have in place before they start to go raise funds? You know, they're giving something up, obviously, as a trade-off there. So just curious, like, what's your take? Are there certain metrics that you make sure that they hit before it's appropriate?
You know, fundraising is really storytelling. And what I try to tell, you know, the folks that I advise, and quite frankly, when I go out and raise money, right? The last round that I helped raise was about $111 million, you know, at a $1.5 billion valuation. And even then I take the same approach, which is like, what story do I have that is compelling? And so quite frankly, the metrics change because I'm building my story, right? And so what I like to do is I like to look at all my metrics and then tease out which one of these metrics can I put together to have a cohesive story of growth, right? Because sometimes you're going to have, you know, some of the stuff is just not going to look good. And you just got to put makeup on it, right?
Yep.
So long as it's real numbers that you're presenting, at the end of the day, when you're doing the actual due diligence, like everything will come up, right? So it's not like you can lie. But you have to present the story. And so what I tell founders is, you know, the timing is when you feel that you have a couple of quarters of a story that shows a trend, right? With a strong value proposition and product roadmap for that future, right?
Got it.
It has to be believable enough, right? And that doesn't need to be in terms of just financial metrics. It could be traction in activity, right? Because a lot of companies get funded before they've even figured out the business model, but they have to have something that shows that they have something special, and you got to tease that out.
Got it. So some level of story, some level of a story and something that you can kind of follow up with to present your case as to why this is something that should be an investment. I get that. What are the trade-offs, or what are the things where you're like, hey, you might be a little too early, or you've got a great story, but have you thought about keeping all the equity for yourself and not fundraising? You know, what's that conversation like? And are there any things in particular where you're like, yeah, this definitely makes sense for you to hold on to? You don't need the money.
You know, a lot of that, it really depends on what the founder wants to do eventually and what their thought process is at that moment, right? You have founders that understand that what they do is they want to build to get acquired, right? They know that. They start with that mindset, like, I want to build something that I'm going to put in a position to get acquired by one of the big, you know, corporations. There are founders that say, hey, I'm going to take this thing to IPO, right? And at that moment, they may not be thinking through that, right? Because as we know, the IPO market right now is frozen.
Yep.
And I think that the proposition of IPO is very different than it was like even 5 years ago. 5 years ago, you would join a company and it's like to the moon, baby. Now, I think most people know that IPO is probably not in the cards and they have to figure out. But honestly, the founders need to have an idea of what it is that they want to do, right? And if a founder is saying, hey, I want to build something. So in terms of what you're giving up, there's it really depends on where you are and how much money you need and how much you can actually bootstrap yourself, right? To bootstrap, you have to be able to bootstrap, right? But if you're going through, I've seen some founders that put a bunch of debt, they take on a bunch of debt, they do a bunch of things to try to hold on to the equity, and honestly, it's to their detriment because they are taking a lot of personal risk, and you want to de-risk yourself too, right? There's other founders that, quite frankly, they dig into their family and friends a bit too much, and then break relationships because there's the lack of sophistication in the risk that those folks are taking, right?
Yep.
And so you just want to be measured about those things. And I always tell founders, look, 0% of 100% of zero is still zero,
Yeah.
right?
Yeah, right.
So I'm always like, look, what do you ultimately think you could build with this asset? And then think about it from that perspective, because if you try to be a little too focused on your equity position when you haven't built anything, that's just it's not a good mentality. At the same time, you want to make sure you don't overly give up equity. So you want to make sure that you're measured in how much you're giving. You never want to give up 20% of your company from jump, right? Like that.
Yep.
You don't want to start there, right? You just want to be measured about that. And there's a lot of vehicles, right? There's convertible notes, there's safes, there's other things that protect you early on as a founder, and you should do that before you do a priced round.
Yeah, yeah, absolutely makes a ton of sense. Are there, how do you help, or do you help them identify what's the appropriate amount that they should be asking for, right? So how much should I actually raise? What are those things going to go towards? And, are there, real conversations? You're not asking for enough because you're going to go back to ask for somebody, for another round in 3 months because you're going to burn through this, or you're asking for way too much. Like, how do you kind of figure that out?
Yeah, well, you have to make sure that you see your forecast from a realistic standpoint, right? I think sometimes people have the tendency to over project their revenues, and that could be a real cash flow, issue, right? Back to the not asking for enough. I'm always like, look, there's the forecast you present, and there's the forecast you plan for. And the forecast you plan for has to be way more conservative because the number one rule is not running out of money.
Yep.
Right. And so that's the first thing that I go and I try to look at and be like, how realistic are we in terms of our ability to generate revenue? And then make sure that we have multiple scenarios for that. In terms of not asking for enough, it depends on if the valuation is right. You should get as much money as you can for the valuation, right? Mm-hmm. The trick is going to be that balance between valuation and raise, because that's ultimately going to, tell you where your dilution is going to be, yep. Right? You also don't want to take a valuation that's too high that puts a bullseye on your back, because then you're going to leave investors with a bad taste in their mouth, right? I've been in situations where investors have put in money and then they felt burned after the fact, right? Mm-hmm. Because they were like, I overpaid for this asset, right?
Yep.
So there's a good balance of where you want to be just realistic of where you should be based on your trends, based on what, the current multiples that you should be looking at, and based on the business that you have at the stage that you're raising. So it's a complex situation. There's no easy right or wrong answer there, because it's a mixture of all those things.
Yeah. And, it's funny. I don't know the percentage, but I would imagine that most of the time when an initial investor makes an investment and there's a second round, they're probably the first place those people are going to ask for those additional dollars, or not. Are you not seeing that?
I mean, for sure. You definitely want to. You definitely want your, particularly in the early periods, right? In the early periods, you want those early supporters to keep supporting you, mm-hmm. Right? You want to make sure that you're going back to that well, because quite frankly, it's easier to go back to a known entity. I think after you get up to the B, the C round, you want to bring in some institutionals that their brand on your cap table will make it easier for you to raise in the next round, yeah. Right?
Yep.
And so we at Envoy, we're backed by Andreessen and Menlo. And so that alone gives future investors a certain bit of confidence. Hey, these are marquee names. They've done their diligence. There's smart people there. I can put my money behind them. If your cap table is just full of a bunch of B's and C's, VCs, it's much harder to raise money.
Yeah, Absolutely, that makes a ton of sense, especially for many people that just have the capital but aren't a sophisticated investor, right? That are throwing some money at something. Um, any major pitfalls or mistakes that you see when people are receiving the funds, or things that they're spending money on that they absolutely should not have no business doing? I'm curious. I'm sure you have some nightmare stories, but just curious, kind of like anything in particular.
Yeah, I mean, the biggest pitfall is thinking that you're going to be able to raise money again, right? At that valuation, at your time frame, right? At whatever amount you think you're going to be raising. That's the biggest pitfall. And so the thing to do is continue to operate pretty efficient, pretty lean, right? And I think the thing that I've seen people do that's a mistake is they go by spreadsheet math when it comes to sales. And what I mean by that is they say, okay, well, if 2 sales reps are bringing in this much, then and I get 10 sales reps, then that should give me 5x the results. So let's go out and let's hire 10 sales reps. Let's bring in a bunch of BDRs. Let's bring in a bunch of people. When you haven't really figured out if your pipeline can actually hold, right? Like, can your pipeline feed these additional people? And so you get into a situation where you've overinvested in people, and then you got to retrench. It leads to a riff. It leads to other things. And quite frankly, you see that you are burning money like it's going out of style. And I think that's the biggest pitfall.
Got it. Yeah, because listen, what 3 biggest expenses for any business are going to be their real estate, their salaries, and their health care, right? So, like, if your people are costing you a ton of money and they're not bringing in the revenue, that makes a ton of sense. And you can't really control, whatever you're spending on real estate. Hopefully, some of the virtual work from home may help reduce some of that cost. But that makes a ton of sense. Any things that you absolutely recommend using the capital for when they're raising it?
Using the capital for when they're raising it. I mean, look, in tech in particular, in startups, it's mostly people, right? So usually,
it sounds like it's the people are critical. Can't overhire, can't underhire, right? And you've got to hire the right people, right? Does that make sense?
I mean, I know it sounds simple, but that's really the key. You cannot overhire early on. You can't overhire. You got to bring in the right people for the right stage, and that's the other thing. You can't. One of the things you should not do is go out and bring like a super. In my opinion, you should not come in and bring in like a super seasoned executive that's going to cost you, $1 million a year because they're going to solve everything. A lot of those people don't fit well in small companies that are starting up, right? There are people for every stage. And I think one of the biggest challenges that I see founders have is understanding those stages and understanding when you need to level up, right? The people that get you from 0 to 50 are not the same people that get you from 50 to 100, and not the same people that get you from 100 to 200. So you have to identify that.
Yeah. And do you typically hire outsource that capability, or recommend somebody go outsource that, like when to acknowledge what that next fit looks like? Or is that a conversation that you're having with folks? Like, hey, listen, you might need to replace yourself as the CEO of this thing because you need somebody with more experience. And I'm sure that's an interesting conversation too.
Yeah, well, that's more like the board needs to have that conversation. No, but I think that's where the board comes in and gives that counsel, right? So you want to make sure that you have a board with some advisors that can walk you through that, because a lot of times those are hard decisions because those are your family, right? Those are those people that were in the trenches with you, right? Like literally you guys were taking grenades, and now you have to look in the mirror and say, okay, Joe or Jane cannot get me to the next level. And there is a tendency to say, hey, where can I fit Joe or Jane in the organization? And sometimes the answer is nowhere. And I think that's one of the biggest sort of helps and supports that boards early on do, is helping you think about your organization, making sure you got the key players and you can identify when you need to up level.
That's a great point. I mean, having a seasoned board, not a bunch of yes people on that board, right? Really giving you some true to some true guidance. And yeah, I mean, I can imagine, having a small business and people being there with you from day one, and at some point having to replace them because they're just no longer capable. That's tough business right there. That is real business. I can imagine that that's a difficult conversation to be had.
Yeah, it's a really tough conversation, and quite frankly, is something that people get wrong a lot. I think back to pitfalls, it's one of the things that you see repeat itself over and over and over again. And that's because a lot of the founders, they don't have the experience to even understand what these levels look like, right? Yeah. They are scaling themselves. And to your point, so they're not even able to look in the mirror and say, when it takes a very special CEO to be like, we need to bring in someone now that's better than me to do this job.
Yeah.
I've rarely seen that.
Yeah, absolutely. And, whenever you're sort of advising these startups, what's the conversation like between offering your, cash salaries versus offering some type of equity stake in the company? What's that conversation look like back and forth? And do you have sort of any type of guidance there?
Yeah, it's a tough environment right now to do that. It's a tougher environment, I should say, because right now I think you want to bring in people that are, the best that you can hire at that level at that time. Mm-hmm. Right now, more people know that IPOs are not as, available as they used to be. They are looking at liquidity and equity with a bit more skepticism, but you're still competing for talent. You're still competing for the best talent that you can actually acquire and attract to your company. I think my advice is just have a philosophy around compensation early on, because you're going to lose some people, right? So if you're saying, hey, you know what, for engineers, I'm going to go aim for the 75th percentile in terms of comp structure and bands, you got to be okay saying no to people that are really good but are at the 90th percentile. Right. And you just have to have an understanding that you're going to lose a lot of candidates early on, because if they're that good, they can go work at Google and make $1 million. Right. And so it's a much tougher thing to do now. And you are leaning a bit more on cash than I think before. Before there was this thought that people would just join startups for no money with the promise of equity. Right. Yeah. And I've seen that. But that was in my Etsy days. That's 2008, 2009. Right.
Yeah.
I think right now people go into this saying, yes, I love you, but I got to pay my bills. And by the way, things are so expensive. And where's my cash compensation? You still want to make sure that you understand your philosophy.
Yeah, that's a great point. Because again, I think one of the major things that I'm leaving this conversation with is that the people aspect of it is one of the most important things that you have to nail at every stage, right? Upfront understanding, I need to find the right people at the right cost, the right compensation structure, because if you screw that up, you could really burn through all the cash that you just raised or potentially go out of business, right? So, and then the right people in the right seats at the right time is also sort of another really, really important factor. So I'm getting a ton of clarity from the conversation, so I appreciate it.
Yeah, and one thing that I would add is that, you have to not be afraid to fire people, right? Mm-hmm. Again, one of the most difficult things to do in a business, but if particularly early on where money and burn is so at a premium, you cannot have the people that are not right fits in your organization. And there's a tendency to delay those kind of decisions. My advice is just have clear goals and expectations set from the beginning, and try to look at the early indicators that will tell you if that person is going to be a fit or not, because you have to move fast and you have to make those decisions quickly. And that's another thing that young founders are challenged with, because firing people never gets easy, no matter how many times you've done it.
Yeah, no question. I mean, it's the worst, but I've always sort of lived under the hire fast, fire faster, really trying to identify if somebody's not the right person. I almost look at it as, sort of again, maybe it helps me sleep at night a little bit better, but it's, helping them. If it's not a fit here, maybe there is a better fit for them somewhere else where they're going to be happier somewhere else. So
Exactly.
As we kind of wrap up the conversation, are there any particular things that you think, young startups should consider, think about, anything that you really want the audience to kind of take away from our conversation?
Well, again, back to the earlier point that I said at the beginning of our conversation, it's a different time, but things always swing back, right? Mm-hmm. So you just have to basically like stay put, understand that it's going to be, it's going to be a grind for a while, but there is a lot of money out there. There is still a lot of money sitting on the sidelines. There's a lot of dry powder. And even in the good times, a founder should have expected to have like 300 no's before they get to that one yes, even in the good times, right? And so if you put it where we are now, like you have to get through a lot more no's before you find the yeses. You have to be out there. You have to be networking. You have to be in the places where people are showing up to. And it's a lot more work, but it's still possible. But don't be discouraged by no's, because again, even in the good times, people got a ton of no's. Right now, the founders need to really grind, be out there. And your number one job is always fundraising. There's not a time to fundraise. You are always fundraising. You're always connecting with investors. You're always connecting with VCs. You're always where other founders are. You're always fundraising.
I appreciate that. Well, listen, again, I know the conversation was valuable for me, and I'm sure it was super valuable for our listening audience. So really, really appreciate you coming on. And for the listening audience, we'll make sure to tag, if you're looking for advice, looking for a board seat, I know my man here would be welcome to have a conversation. So, Sin, really appreciate you for coming on.
No, thank you for having me. This was really fun. Love the topic. Love the podcast.
You bet.
Thanks.
I appreciate you, man. And to you, the listening audience, thanks for tuning in. Please click subscribe below to be notified when we have our next podcast. Appreciate you.